Today, decoding the Australian economy. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering property and finance news with a distinctively Australian flavour. And today, I want to take you through a journey of discovery, all based around the RBA's chart pack, which came out a couple of days ago. Now, this chart pack is released by the RBA and provides a really comprehensive overview of all the different data series that informs on the trajectory of the Australian economy. So we're going to take some time today to go through quite a few of the slides. And I'm also going to try and weave a bit of a narrative around it to give you a sense of some of the key themes that I think are relevant when we consider what's happening now and what may happen in the months ahead. Now, the chart pack contains content relating to the world economy, the Australian economy, household sector, business sector, commodities, interest rates, share markets, and other data sets too. And as we move down the series of data and begin to look at the different dimensions, we can begin to understand what's really going on. So what I'm going to do is to walk through some of these slides and build a picture of what I think is going on. Now, you could argue that some of the data may be myopic and it may be, of course, driven by the RBA's agenda, but nevertheless, it does give you a relatively comprehensive view of what is going on. But there is an opportunity to build a story around this, and that's what I want to do today. It may take a little while, but hang with me. So a good place to start is with world growth, which actually is slowing. And of course, last year, the narrative was all about synchronized growth around the world and how wonderful it all was. Well, that's really all turning to custard now. We're seeing significant changes in the growth story, and a number of economies around the world are now beginning to face headwinds. To give you one example, China, of course, has had very strong growth for a long period of time, but the rate of growth is slowing. And the latest data, which of course the chart pack doesn't necessarily cover, suggests that growth will continue to slow, although it is still going along at a fair clip. Nevertheless, the fact that growth in China may be slowing has significant implications for us here in Australia. And it's not just China, but we can also see growth slowing in places like South Korea and Malaysia, although Indonesia looks as though it's continuing its momentum at the moment. But if we look at the advanced economies, we can begin to see some decline in growth there, although the US is still relatively strong thanks to the so-called Trump bump. But of course, the risk now is that that could turn into a Trump slump as the Fed continues to lift rates. But certainly in Japan and in the Eurozone, growth is slowing, measured, of course, by GDP. Now, we can have a separate discussion as to whether GDP is a good measure of true growth. My argument is it's very myopic, and it really doesn't take account of the sort of advanced economies that we have, but nevertheless, it is still the measure that is used around the world, and therefore we will use it too, because that's the way the data is presented. But to be clear, the GDP measure is not fundamentally a very good measure, not least because it doesn't, for example, take account of the real costs of housing, and it is inflated by activity, not necessarily productive or profitable activity. And now the next dimension to look at is inflation. And here you can see that inflation is still relatively low. And in fact, it's one of the big conundrums that inflation is still below the 2 to 3 typical target band of most of the central banks in the advanced economies around the world. And there are lots of debates about why that is. Is it to do with the automation and the rise of computers effectively taking jobs away? Or is it something else? And that something else could be, for example, that wages are under significant pressure. It's also worth noting that inflation is falling in India and is moving up just a little perhaps in China, but if you look at the very end of the chart series, you'll see that it's beginning to slide back there too as growth in China eases. And we also see similar trends in terms of inflation easing in a number of other East Asian countries too. Now, if we then look at the labour markets, what you can see quite clearly is that overall unemployment rates are coming down, particularly in the advanced economies. But of course, you've got to ask the question, are those measuring the right thing? The definition of unemployed has effectively been narrowed to the point where somebody with an hour's work a week is not necessarily classed as unemployed. And that helps to bring the numbers a lot lower. The unofficial unemployment rate, for example, in Australia could be 8 or 9%, according to some other measures. And then the other thing to notice is that wages growth is relatively benign. And this is one of those conundrums where unemployment is falling, but wages growth is not rising. And there's a pincer movement there that is not fully understood by many of the economists around the world, in my view. So now let's turn to GDP growth in Australia. And this chart shows you that GDP is actually falling in Australia. In fact, the last outturn was significantly below expectations. And whilst the RBA has been forecasting a growth rate of 3% plus, my own view is that's unlikely to be achieved. And we will see continued falls in the GDP result in the months ahead. And it's also worth noticing that compared with a few years ago, GDP is significantly lower now. Now, if we look at the contributions to GDP growth, that actually is quite interesting because essentially what it's showing you is that consumption, household consumption, is nearly half of all GDP. Now, that's lower than in the US where it's 2/3, but it's still very significant. And then we have a contribution from dwelling investments, from mining investments, from non-mining investments, exports and imports, and public spending. And in fact, the second biggest contribution to GDP growth is, according to this data, at September 2018, public spending. In other words, infrastructure investment spending. Now, the next chart is showing the contribution of mining and non-mining activity. And this is quite important because, of course, the Australian economy has been supported for a good number of years by mining activity. But we also know that mining investment has slid away in recent times. And whilst we are still getting a contribution from resource exports, the net contribution from the mining sector continues to look as though it is going south. But the other point to note is that the non-mining sector of the economy, to other businesses other than mining, is also not doing particularly well. It's below 3% in terms of growth. And whilst there's a slight uptick now, we are seeing the non-mining sector growing at a relatively slow rate. And you can also look at it from a state perspective. And there you can see the amazing turnaround in WA from massive contributions between 2012 and 2014, and then a significant fall away as the mining sector really took a dive. It's no wonder that WA is struggling. And the rest of Australia, though, is also on the slide, and even New South Wales and Victoria, regarded perhaps as the major states, we're also seeing the state final demand sliding there too. So in other words, across the country, it looks to me as though economic momentum is on the slide. So now we're going to look at CPI, consumer price inflation, and here we can see that CPI is sitting around 2%. But if you look at underlying inflation, which effectively removes some of the volatile items, you can see that underlying inflation is well below the 2% target. And remember that the RBA has one of its targets to be for inflation to be between 2 and 3%. Now, there's an interesting question in my mind as to whether that is a reasonable setting given everything that's going on, but it is the target that's been accepted by central bankers in most advanced Western countries, and most are trying to manage within the 2 to 3% band, many unsuccessfully on the downside. So now we come to the household sector. And here, the chart on household income and consumption really does get to the heart of the issue. So the first thing to notice is that disposable income continues to fall. In fact, many households, according to our surveys and other data, have had no rise in real disposable income for 5 or 6 years. And we also see that consumption has been running ahead of disposable income. Although now, if you look at the latest data there, you'll see that in fact consumption is sliding a little. And the question then is, well, how are people paying for the consumption that's greater than disposable income? The answer is, 1, they're borrowing, and 2, they're raiding their savings. So the savings ratio continues to go down. Now, some people have argued, including the Treasurer, that the reason the savings ratio is dropping is because of high levels of confidence in the household sector. But unfortunately, I don't think that's right, because my survey data indicates that many people who are raiding their savings are people with an income shortfall, because incomes have not risen whilst costs of living have, and therefore they're squaring the circle by raiding their savings. So to my mind, the falling savings ratio is not a positive indicator, it's a negative indicator. Now, one of the really interesting perspectives here is the amount of activity in private dwelling investment, because as you will know if you've been following the DFA channel, a lot of the momentum in the economy is to do with housing and residential investment. So private dwelling investment has climbed significantly, and we can see that very strong run-up from 2013, of course facilitated by significantly larger mortgages that have been made available and the growth in overall housing credit. But it does look as though that party may well be over, because the private residential building approvals has really started to decline. And if you look carefully with the data here, you can see that whilst detached housing approval is down a little, most of it relates to a fall in higher density housing. Now, of course, that is because the property investment sector has really gone off the boil, and we've got 200,000 or thereabout units coming on stream from partly completed properties at the moment. And so the number of new high-rise approvals are dropping, and that was, of course, before the recent issues that came out from the Opal Tower at Olympic Park and other places, where we know that perhaps some of the construction issues are also now coming home to roost. And it's worth remembering that building approvals tend to lead the outcomes by 12 to 18 months, simply because it takes time, once you've got the approvals, to start gearing up to build and then sell. So this is a forward-leading indicator of significant slowing in the economy ahead. Now, one of the other critical charts is the housing prices and household debt ratios. And you can see there on the left that housing prices are really sliding back. And this is a ratio, of course, to annual household disposable income. Now, housing prices are sliding. And household debt is still very, very high relative to disposable income. So this underscores again that households are leveraged up to the gills. And remember that these are averages across all households, and only 1/3 of households are actually borrowing for housing purposes. So effectively that ratio doesn't tell you the true story for borrowing households. It's just an average across the total economy. And another way of looking at the same thing is to look at household wealth and liabilities. So here we can see that net wealth is falling. Now that's quite a new phenomenon. Up until quite recently, household net wealth was climbing significantly thanks to, firstly, the rise in dwelling prices, and secondly, also the rise in the stock markets and other financial assets. And of course, what we saw there was that liabilities, in other words, loans, were growing, but not quite as fast. But now we've got the situation where dwelling prices are sliding. And of course, since this chart was produced, we know that the stock markets have also come back. So the ratio between the two, and therefore total net wealth, will continue to slide. Now, that is really important because net wealth, and specifically a fall in net wealth, will have a very significant impact on households' willingness to spend and invest. And it may well be, again, that this is a leading indicator of a slowing economy ahead. Now, as I signalled before, housing prices are sliding, and all of the major indices, as reported here, are showing a fall. Now, these are averages, of course, and they're seasonally adjusted, so they don't tell you the truth of what's really behind them. In some suburbs, we know that prices are down up to 20-25% from where they were. In other suburbs, there's almost no fall. It does vary by state, it varies by type of property, it varies by location. But home prices are on the slide, and my expectation is that home prices will continue to slide in the months ahead. And you can directly correlate the fall in home prices with the falling home loan approvals. Now, as I have said many times, the strongest correlation is between availability of credit and home prices. So as credit tightens, home prices fall. And we can see this in terms of the home loan approvals. The total approvals are down in terms of the value. And the main falls have been in the investor sector, particularly since the APRA tightening. But it's also worth noting that owner-occupied borrowers are also now tightening as well. So less loans are being approved, which of course is one reason why there's been talk recently about the banks have been over-tightening their lending criteria and should free them up a bit. Now, as I said on several occasions, that's nonsense. The banks are now complying with their lending obligations. Last year they weren't. So I don't think there's going to be a consistent reversal. There may be a few at the margin, but frankly, home loan approvals are likely to continue to fall in the months ahead. And because of that, I expect home prices to slide further. So let's switch to the business investment side. And it's worth just highlighting first that the share of nominal GDP relating to business investment has actually slid significantly over the last decade. Now, that's quite a worry, because essentially up until the mid-2000s, it was the growth in business investment, particularly mining, of course, that was really stoking the economy. That is no longer the case. It's now reversed. And just to draw that out, you can see that the capital expenditure for the mining sector has really come off from its peak, whereas the non-mining sector is growing, but growing relatively slowly. So another dimension here is to look at business investment components. And here you can see that machinery and equipment investment is consistently down from the early 2000s, although there might be a little peak now. Investment for buildings is way off and continues to fall. And investment for engineering purposes is also sliding. So there's very little here to suggest that we're going to see very high levels of business investment in the months and years ahead. And another way to look at this is by the industry share of business investment. You can see mining coming off from a very high peak, and you can also see that other business services has been growing quite fast. That, of course, includes the real estate sector. So now we can look at credit and the broad money growth. And here, both credit and broad money supply is falling. Housing credit growth, of course, we all know that, is off, particularly investor credit. And if you look at credit growth by sector, you can see that housing credit is falling, personal credit is falling, and there is a small uptick in business investment, albeit from a relatively low base. Now I want to look at wage price growth. And the index shows that wages are growing relatively slowly. They've been languishing at around 2%. There's a small uptick, but of course that's an average. And in fact, it's public sector wage growth, which is running significantly above private sector wage growth. In fact, private sector wage growth on average is still below 2%. And many households working in the private sector have had no increase in at least 5 or 6 years. And another way of looking at this is to look at the average earning per hour. Because what this shows is that recently the average earnings per hour has fallen. And this also shows that the numbers are driven by more jobs and more hours worked, but the average numbers of hours worked by the average employee continues to go backwards. Now that is partly reflecting the employment participation rate, which is relatively high, and the ratio of employment to the working age population, which is also quite high. So we have more people in work, but on an unit basis, on an individual basis, the impact of that is not being seen in wages growth or more hours worked. And that translates through to the underemployment rate, which is still sitting above 8%, which is a lot higher than it used to be. If you go back a decade, it was well below 8%. And in a way, the unemployment rate, which is way down, it's close to 5%, doesn't tell you really very much at all when you actually come to look at the real numbers. And so now if we look at state unemployment, you can see that Victoria has really taken unemployment rate down along with New South Wales, but some of the other states are considerably higher. But it's worth asking what type of jobs are actually growing. And the really interesting and concerning issue is that it's the household services sector, which is really growing the fastest. And the thing to understand about that is the other business services sector. It includes things like healthcare and education. And this really touches on what I call the bedpan employment issue. We have a lot of people now working in lower paid support services in the caring sector, which is a really critical sector, but doesn't pay very well. And the growth there is not necessarily creating significant contributions to the bottom line of Australia Inc. It's very much being paid for by other people in the community. So, in a way, the growth in jobs and the lack of growth in GDP is explained by the fact that the growth in jobs has been in non-productive, from an economic perspective, sector. Now, it's very important, of course, because people need support as they age, and the healthcare sector is growing as part of that process. But if you stand back and think about it from an economic perspective, it doesn't necessarily make a whole lot of sense. Now, when it comes to exports, it's pretty important to understand that the bulk commodity exports are mainly iron ore and coal. And in fact, iron ore has come off a little, but coal is still looking pretty strong. And if you look at the destination of exports, you can see that it's China who is really taking the lion's share of those exports. Now, of course, as we highlighted earlier on, China is potentially experiencing a slowdown. So that means that we are very trade exposed to China. And if they do come off and reduce demand, that will have a significant flow back into the local economy here. And one of the other things to understand is that we are very much funding our lifestyle on net overseas debt. So this chart here shows you the gross foreign liabilities and the gross foreign assets. And the gap between the two, which is more than $1 trillion, is the amount that we owe internationally. So Australia is really supporting itself on very high levels of international debt. And it's also worth noting that a considerable proportion of that is actually in foreign currency, not just Australian dollars. Another way of looking at the net foreign liabilities is by the type of debt. So we've seen long-term debt rise to take a position of well over 50%. And short-term debt has come down, which is probably good because short-term debt moves more quickly when interest rates are changed. Now, one of the interplays worth noting is the relationship between long-term and short-term interest rates. And this chart shows you the spread between the Australian 10-year yield and the cash rate. And interestingly, the spread is sitting at around 1%. But the killer is the differential between Australian and US 10-year government bond yields. But you can see that for the first time since 2000, now the differential is such that rates are higher in the US compared with Australia. Now, this is really significant because what it says is that international investors may well prefer now to invest in the US rather than here because they get better returns on so doing. And this pressure on the economy here because of higher US policy rates means that the ability for us to be able to fund that $1 trillion of debt going forward is going to get more problematical, and the cost of that debt is likely to go up. And by the way, this rising cost of bonds is something which is also hitting the emerging markets too, whether it be in Europe or Latin America or in Asia. And of course, we are seeing US corporate bond yields also rising to the point where we know that some US corporates are now having to pay considerably more than they've been used to be able to fund their debts, which are very significant. And a lot of that funding was used to support share buybacks rather than productive purposes. So this is why a lot of people are suggesting that we're going to see more pressure on the US economy in the months and years ahead. So now coming back to Australia and thinking about the variable housing rate interest rates, one of the interesting factors, of course, is that the standard variable reference rate has very little meaning when it comes to true interest rates that people are paying. We highlighted this in a recent post relating to the Productivity Commission report. What's interesting, of course, also, and again highlighted in the Productivity report, is that outstanding loans, the current loans, are much more highly priced relative to new loans. And this is because there is no price on loyalty. Banks are prepared to offer new loans to new customers at considerably lower rates than their back book. And this is a fundamental problem in the banking sector. And unless you proactively switch, you'll end up by paying more, as the Productivity Commission highlighted. And the other thing that's worth noting is that the Australian business lending rates, particularly for large businesses, are rising. That's because of the international funding costs going up. As yet, the interest rates on outstanding lending for small businesses have hardly moved. We think that may change in the months ahead. There is also, of course, differentiation between the interest rates on variable housing loans. Those for investor purposes and interest only are higher relative to principal and interest. And this differential between different types of loans is something that we haven't really been used to seeing for quite some time, but is now a very significant part of the marketplace. Now, this chart shows the share price indices by different industry groups, and you'll see that financial services companies are really sliding, whereas some other sectors are moving up. But overall, you can see a downturn in share prices since October, and that is going to continue in the months ahead, in my view. It's also worth noting that share prices are also down in a number of other markets too, and indeed world share price indices are also lower. So this is a signal of a reaction to lower growth and higher interest rates around the world. Now, earlier on, I mentioned the deficit that we have in terms of funding the Australian economy, and a lot of that relates to non-government issues. And so you can see here that the financial sector has been one of the largest issuers of bonds. And of course, that's because they use those bonds to support the mortgage sector of their book, particularly. And as they run their books forward, they will need to continue to borrow on the international markets, despite the fact that now prices are rising. And that's one of the critical pressure points going forward as effectively international funding costs rise. And it's also worth pointing out that bonds issued in Australia are also climbing, and a lot of those are from non-government sources. And a lot of those bonds are being taken up by superannuation funds. And what that tells you is that those superannuation funds are indeed also leveraged into the marketplace through that mechanism. And this is a picture of non-government bond issuance, showing both domestic issuers and non-residential issuers. And you can see there that it's domestic issuers who are taking the lion's share of the action. And this shows you the in-flight situation. And you'll notice there that financial companies and asset-backed securities are both very significant. Now, the final thing we're going to touch on is Australian bank profitability. And this shows that overall profitability has slid over recent times. And the majors are, though, managing to maintain greater levels of profitability compared with other Australian-owned banks. And by the way, those sorts of returns, well above 10%, are still pretty good on an international basis. Now, this chart is just showing the bank's non-performing assets. And you can see that the share of all loans that are non-performing has come back from 2012. But you can also see the rise in housing non-performing loans and personal non-performing loans. Now, this is just looking at funding composition of banks in Australia, and you can see there that around 60% of funding is from domestic deposits. There's around 20% which is short-term debt, and around 12 or 13% long-term debt. But notice that the equity share is very, very low. And as I've been saying quite frequently, one of the factors in Australia is that the banks are highly leveraged. In fact, if you take the big four banks, around 5% of their total funding is equity-based. The rest of it is leverage, which is why they are so exposed in a downturn. And the last chart relates to the bank's capital ratios. Now, this is effectively looking at things like the common equity tier 1 and the tier 1 capital, and also tier 2. What's interesting, of course, is that these are risk-weighted ratios predominantly. And what that means is that banks can lend for housing using very low levels of capital. I've said for some time that I think the capital ratios and the way that they're used to create leverage in the banking system creates significant risk for the banks and indeed for the broader economy. That's a bit of a rundown of all the major dimensions of the data, but now let me try and put it together for you. So we know that 1, housing lending is coming off the boil, credit is going backwards, credit will drive house prices lower. 2, we know that the resources sector has been supporting the economy, but that's come off the boil, and we know that China is looking a bit softer, one of our major trading partners. 3, we know that household consumption has been the key driver for GDP growth, and now because of higher debt, because of flat incomes, because of rising costs, and because of the fact that the wealth effect is now reversing as home prices fall, it is likely that households will hunker down more. So it's unlikely, in my view, that the GDP number will be north of 3% anytime soon. And so what you begin to see is that the debt-driven, housing-driven, consumer-driven economic model that we've had in Australia for a decade is now looking as though it's running out of legs. And unfortunately, we don't really have a plan B. Seems to me that all the recent conversations is about trying to re-resurrect the housing lending sector to be able to actually give the GDP number a further kick down the road. But my argument is we need a strategically differentiated plan to be able to take us forward. We cannot rely on just inflating household debt. And the final nail in the coffin, of course, is that 1 trillion of debt internationally that is supporting Australia is now going to experience considerable rise in costs as the international environment changes, as the Fed continues to move rates higher, and as quantitative easing and other factors play out. It means that asset prices around the world are also going to go backwards. So we are, I think, in a risk-on environment, and that's one reason why share prices are down compared with last year, and why I don't believe that we're going to see the share markets bouncing back anytime soon. We are in for a long, slow grind. And to be clear, the housing sector miracle cannot continue. I'm Martin North from Digital Finance Analytics. If you liked this post, please share it, add a comment, add a question. I read them all. Many thanks for watching, and I'll see you next time.